Hi, everybody. Thank you for joining us for the fourth quarter of the Feldmeyer Forecast. It's hard to believe that we're already in the fourth quarter of 2025. I feel like we just did the summer quarters, which I guess we did, but hard to believe that we're already at the end of the year this quickly. We are going to get through a handful of things today. We're going to try to keep it short and sweet in terms of the messaging on things, because ultimately we have a pretty optimistic outlook in terms of things for the remainder of the year and into next year. But there has been an awful lot of things going on in the news, so we'll be sure to address everything that we can here in the next 20 or so minutes. We're going to take a look at basic economic updates in terms of where we are from tariffs, inflation, and interest rate cuts, as those tend to be the big high points for the quarter. We're also going to take a look at a few things, though, in terms of the S&P 500 and some of the concentration risk of the S&P 500 continues to grow in that top quartile, so we'll take a look at that. Also, how AI has shaped a lot of the market growth over the last quarter and how it will probably continue to do so, and how to take advantage of that from an investment standpoint. So to get us started, we are going to take a look at, if you joined us last quarter, we did a new segment where we are running through quickly all of the top headlines over the last quarter, because believe it or not, an awful lot has taken place since the last time that we spoke. So taking a look at things from general news all over the board, starting at the beginning of the quarter, we had Congress and President Trump passing the big, beautiful bill. We had Jurassic World Rebirth opens as a big summer blockbuster launch. However, Superman became the quarter's top domestic grossing movie release. The Supreme Court actions further enabled the administration's moves to reduce federal workforce and restructure various agencies. The US and the EU reached a framework on reciprocal trade. Trump administration announced broad AI export and regulatory agenda designed to accelerate AI sales to allies and loosen environmental rules. The Federal Reserve met at the end of July and held rates steady at 4.25 to 4.5% after the July meeting, but then subsequently cut by 1/4 percentage point in September. The Bureau of Labor Statistics Commissioner was fired after release of weak jobs data. An executive order was issued imposing a 25% penal tariff on imports from India as a response to India's purchases of Russian oil, as well as various other tariffs that were put in place over the course of the quarter. The 2025 US Open commenced for tennis fans, and unfortunately, several Americans fell short of expectations in terms of progress there. The biggest pop culture news of the quarter was Taylor Swift and Travis Kelce's engagement. The US-Japan trade agreement was signed, setting Japanese import tariffs at 15%. US unemployment rates near a 4-year high, but labor markets hit a stall. There was the fatal shooting of conservative activist Charlie Kirk at a campus event. Europe defeated the US 15-13 in the Ryder Cup for golf fans amid crowd controversies. Companies and mid-market firms reported margin pressure from tariffs and inflation in Q3 surveys. The NFL announced that Grammy winner and Puerto Rican star Bad Bunny will headline the Super Bowl halftime show. Analysts warn that markets may be underestimating Q3 corporate profit earnings strength. Government shutdown looms as parties fail to reach a deal. And overall, the markets finished Q3 strongly as tech and AI optimism lifts global equities.
All within 90 days.
So when we take a look at some of those items at a little bit more of a granular view, one of the big headlines for the quarter was that we saw inflation creep up steadily each month.
And we don't expect that to slow down. The outlook is that the tariffs are going to actually catch up with us. It's fourth quarter news, but it was news this morning that more and more companies are finding they're going to have to pass on the price increases or eat it, and their profits are going to suffer. So it is going to catch up with us sometime over the next 6 to 12 months. It can't not.
From an economic outlook from several of the economists that we listen to on their quarterly updates, the expectation that most of them are agreeing with at this point is they expect inflation to probably peak at about 3.5% sometime next year, The average estimate seems to be by about summer of next year, we should see 3.5. Could come sooner or later, it could be higher or lower, but that's essentially what the consensus is at this point.
Notice as well on the chart that where there's color below the line, that would indicate that prices have fallen in those areas. And the color coding is indicated there on the top right-hand corner of the slide. Where we're seeing now is that we don't see anything from a category that is falling in price.
Tariffs have also, of course, been a big headline. We saw various extensions of deals and new deals be created over the course of the quarter, which is great. When we take a look at things, though, there were more that were added over the course of the quarter. When we look at the effective or average tariff rate in the United States last quarter, at the end of the quarter, we were sitting at about 14%. At the end of September, it's now up to 19% in terms of tariff rate.
And Alyssa, if you would highlight the numbers there in the year-to-date totals column in the box up there. We see the total tariff revenue as the top line, and then we see total imports, and then the revenue as a percentage of the imports is indicated on the lower, on the last number there. We see this number starting to climb as we move from left to right, and year to date, the total is about 6.2%. Now, looking at the blue line on the right-hand side, indicating that as of a couple of days ago, September 30th, the nominal tariff that's being imposed on imported goods is 19.2%. That would indicate that things are going to continue to climb and that the totals on things will catch up, because they're pretty low here on the left-hand side of that line because the tariffs were just getting initiated earlier in the year. And now we see the bigger numbers, 10%, 9.5, 11.3 starting to catch up. That number is headed toward 19%. There's no way that this can't be inflationary. It just is. The question is it's going to have a big enough effect on the economy that it's going to slow things down materially? And our outlook is maybe not. Maybe in some industries, maybe not. And sorting out the difference as well. Alyssa and I were talking about this earlier, about the difference between the economy and the marketplace. These are very different things, and we need to be aware that the market is focused on one thing and one thing only, and that is profits. So we're going to take a look at where some of the profits are coming from here as well today.
Mm-hmm. One other note, and we don't have a specific slide for it today, but taking a look at interest rates and our expectation there, we saw rates be held steady for quite some time, and we've seen them just start to indicate a little bit of easing in terms of the rates. That is also going to create stimulus in effect into the economy by loosening of rates over the next several quarters in terms of expectation. That can also be inflationary and something to keep in mind as well. So we will see as Jerome Powell's term ends next year, who's going to take over and how that's going to look in terms of reshaping some of the people on the board as well.
This slide has a lot of information on it. So if we start on the left-hand side, what we see is in the box on the line that indicates returns, the year 21, 22, 23, 24, and year-to-date 2025. Okay? This is the returns. The S&P 500's numbers are right below that. Then in blue, we've got the S&P 500 minus the biggest 7 companies, the Mag 7, as they're called. And what we see is that there is a significant drop in terms of the performance. Then we look at the green lines, which indicate the performance of the Magnificent Seven. And then right below that is the percentage of the rate of return that they are accounting for. And these become an issue when we look at things and we say, gosh, in 2024, 55% of the rate of return of the S&P 500 was driven by 7 stocks. If we look diagonally down at the Magnificent Seven performance dispersion, each year there we see in 2021, 2022, 2023, etc., The number one performing stock, let's just take a look at 2021, was up 125%. The worst performing of the seven was up by 2%, with the average being up 50%, which tells us even among the top performers, just because you're great big and you're one of the Magnificent Seven doesn't necessarily mean that you were lighting it on fire along with everybody else. We see in 2023, the best performing stock up 239%, the worst performing stock up 48%. There's a fair amount of dispersion here. And look at year to date this year. Number one performer up 39%. The worst of the Magnificent Seven break even for the year. So even within those seven stocks, we see there's just a couple that are really pushing all the performance numbers forward. Above that, we look at earnings growth. In green, we see the earnings or profit growth of the Mag 7, clearly outperforming everybody else since 2023. The rest of the S&P 500, the other 493 companies, profit growth indicated by the blue line. Now look at the forecast though for 2026. What we see is that there's an expectation that the other 493 companies in the S&P 500 profit growth will start coming closer to what these seven companies have been able to do.
And what happens on their balance sheet versus what happens in their stock price is also not always the same thing either.
It's the same thing either. That's correct.
So between, increases in expectations doesn't necessarily mean the stock price will do exactly that, but it does mean the fundamentals should be there for it. So then the rest is up to investors in terms of where to put their confidence.
Correct.
When we take a look at another metric of the S&P 500, let's broaden out a little bit to just look at the top 10 companies within the S&P 500. Historically, when we look at 10 years prior in 2015, 10 years before that in 2005, and so on and so forth, the majority of those decades show that about, give or take, 20% of the S&P 500 was driven by the top 10 companies. Now look at the 2025 numbers that have the purple in it. The purple companies are all new within the last decade in terms of the top breaking into the top 10. There are some repeats. Apple is still in there. Microsoft is still in there. JP Morgan and Berkshire Hathaway. But when we take a look at the purple, these are all our new companies. And there's obviously a clear theme within them, right? Very technology forward companies. But we have more than doubled the average in terms of how much the top 10 companies in the S&P 500 sway the entire S&P. The S&P historically has been a benchmark for the entire industry in terms of a broad diversification across big to small companies, growth and value, all sorts of different metrics. Now we look at things to say 40% of the entire index is driven by 10 companies. That's not such a broad indicator anymore. It's becoming more and more of a very generalized look at just the biggest companies in the United States.
And driven by tech.
Mm-hmm.
When we look at that column, JP Morgan, Berkshire Hathaway, if we exclude those, Broadcom, Tesla, Meta, Alphabet, Amazon, all of them are basically technology companies. So if we've got almost 40%, well over a third, on its way to 40% of the value of the biggest 500 companies driven by tech as an industry, the question starts becoming, is this actually a good measurement of a broadly diversified portfolio? Because it really isn't.
Mm-hmm.
So we want to be aware of that when you're comparing things to the S&P 500. And we do it too. It's the most commonly recognized thing that people understand. Right? Say, it's the biggest 500 companies. Okay, how are those doing? But it's being driven by just a handful of companies, and they're all tech.
Yep. What a lot of these also have in common is their investment into and use of AI. And AI will continue to be a massive driver, not only in profitability, but also in goods and services that are offered within the marketplace. As we look at the chart here on the left, we're looking at capital expenditures from major AI hyperscalers. Specifically, they're looking at Alphabet, which is Google, Amazon, Meta, or Facebook, Microsoft, and Oracle, taking a look at their advancements on things. And what we see is a massive slope in the dark color of what we've already seen, and those slanted columns in terms of our forward-looking projections jump drastically in terms of spending that we expect these companies to do. You may have seen within the news this quarter, there was also a lot of big news headlines about these companies investing, including NVIDIA, which isn't on that list, very highly investing into OpenAI, which is the company that created ChatGPT. And as you can see on the right-hand side, that dotted line there shows the launch of ChatGPT. And we're looking at industrial production of high technology companies in terms of how fast we are creating computer equipment and communications equipment and semiconductors and all sorts of other tools that are needed to be able to drive this industry forward. It's on a massive trajectory. Although we can't buy stock in OpenAI directly, they're a privately traded company, you can invest in OpenAI through these same big companies. They are investing directly into OpenAI in terms of generating growth and continuing the AI markets.
The output from that we see on the left-hand side is U.S. labor productivity growth. And where we want to focus is on the end of the graph out there, Alyssa, if you'd highlight that we are seeing increased productivity because of the technology enhancements. I mean, we're using it here in the office. Just the number of things that we used to say, okay, we need to think about how are we going to do this? Where are we going to come up with this? This is going to take a couple of hours for us to brainstorm through all of this. We're getting it done in a fraction of that amount of time because ChatGPT is giving us a platform to be able to work off of to say, this isn't exactly perfect of what we would do, but this is a real good idea. We can work with this. For heaven's sakes, I used it to write a toast to my sister for her 70th birthday at a gathering. And we just put in a ton of information about my sister, and it came up with something that was very witty and rhymed and was appropriate. And it saved me, Lord only knows how much time trying to write a toast for my sister. It's available for all kinds of different types of things, is my point. Not necessarily just we're going to make 2.5 of these in the amount of time it used to take to make 2 of them, although that will be coming along as well.
We're also looking at industries from an investment perspective that are really leaning into AI and using it substantially to not only increase productivity, but also increase goods and services output. You can see obviously up at the top on this chart here on the right, we're seeing obviously IT being first and foremost, but we also look at the finance insurance industries are using AI there's more and more software and new tools coming out every day to be able to make things more efficient, more productive. Education is seeing that in spades, real estate, being able to get to information faster and process information faster is what AI is used for. Marketing, I'm sure, is going to continue to expand in their efforts to be able to use AI to write content and to create images and to do a lot of things that it would have taken somebody a long time to do previously. We are offering a seminar on this. We're bringing in an expert from Janice Henderson that's their head of their equities side of the company, who is going to be coming in to discuss AI adoption and the evolution of AI, the industries and job fields specifically that they think will benefit from or have struggles due to the advancements of AI over the next several decades, and all sorts of really amazing information. We previewed the presentation already and said we have to get this out to all of you. So you should have gotten an invitation for that in the earlier part of October. We're going to be offering that at the beginning of November. Those details will continue to get emailed out. All you need to do is just save the Zoom link and log in on that day. We'll be there ready for you, and we'll also record it and send it out to everybody as well. So taking a look at changes and what we've done in terms of outlook on things. First of all, our outlook is cautiously optimistic moving into the end of the year and beginning of next. There are several factors within the economic outlook itself that are things that need to be monitored and things that we need to keep track of and see how those progress. But from a market standpoint, we have high expectations in terms of profitability for a lot of these companies and continued growth into next year.
Business continues to be good.
Yeah. In that vein, we've taken a look at a couple of things in terms of changes, one of which we have increased some international exposure, especially in the foreign developed markets, think mostly Europe, and also developing markets that have an emphasis on capitalistic companies. So very small weightings in China, much higher weightings in companies or in countries that are seeing a lot of growth due to either change in political views or change in terms of the way that they're running their economies as a whole. We have also moved to more actively traded ETFs. This is a discussion that some of you may have already heard in terms of some changes in terms of our industry as a whole. Mutual funds are just a grouping of multiple different stocks that are wrapped together in a big wrapper and offered with a specific strategy that is actively traded, actively changed on a regular basis while you hold it. ETFs tend to be more of a passive investment, to say there are some changes, but minimally inside of things. Think the S&P 500 tracking index, that would be an ETF. They have now created more of a hybrid type of asset class called actively traded ETFs. That is a hybrid between mutual funds and ETFs. There's a lot of benefit there, but it mostly, for the sake of today's discussion, reduces a lot of the internal fees, but gets a lot of the same strategy that the mutual funds also have. So where appropriate, we've been able to start implementing more and more of those as they've become available to reduce internal fees on the investments as well.
We also increased gold in our models. Gold continues to be an excellent investment. It is a fear trade generally, and the fears that we see today are inflation, which gold is an inflationary hedge. The other thing is uncertainty. What kind of uncertainty, Ben? Well, we experienced it last Friday with President Trump announcing 100% tariff on certain goods coming out of China. The market fell precipitously. Then over the weekend, he backed it off and said, it'll be okay. Everything's going to be fine. Effectively, don't worry about it. And here we are Monday, and the markets are climbing nicely on that news. So gold was up on both days, by the way. Gold was up on Friday, and it's up again today because the money just continues to come into it. The other thing is that gold is an important component in things like chips. There are certain things that only gold can do, and those certain things are in demand at this stage of the game, and the exposure there in our models needs to be increased, and we did increase it because we're making good money for you.
Yeah. When we look at the stock model specifically, there was a fair amount of changes there, mostly, again, adding to the gold percentage of the allocation in the model. But also we reduced our exposure to a lot of the consumer staple type companies, think your Costco's of the world, increased our emphasis on AI and technology companies, adding Oracle, Broadcom, and a few others in there as well.
So to summarize things, still a lot of information every 90 days, but not as much information as some things have taken place, like the big, bold, beautiful bill, right? Now we're sorting things out. The impact of the tariffs will be detrimental, but the impact to the ability for corporations to spend money on capital expenditures and write it off immediately is going to continue to drive a number of different sectors forward nicely, and we are emphasizing those areas.
Yeah. If there are any changes throughout the quarter, you know that you'll hear from us then. Otherwise, we appreciate you all tuning in to the fourth quarter Feldmeyer Forecast, and we'll see you again next time.